Hi guys, in this video we're going to talk about how to calculate your trading profits if you are an active trader, a day trader, anything like that. If you've got some savings, say maybe you're thinking about getting in, this video will show you some formulas and some strategies so that you can be successful. Um, the common saying is 95% of day traders fail. So this video aims to show you how to be one of the 5% that will be successful. So you can see here I constructed some rules for successful trading, and also a profit calculator, a profit worksheet. So number one rule, only invest what you can afford to lose, right? So if you're just getting started, say maybe you have some savings. One of the big rules here, the SEC requires that you have at least 25,000 to be a day trader. So I'm going to assume that you have 25,000 in this example. So if you're just getting started, maybe you try, using 10-20% to start to test these strategies, right? The big thing is practicing. Another big indicator thing that I would recommend is that you use a paper trading account. A lot of these, TD Ameritrade with their Thinkorswim platform has a paper trading account. There's some other ones out there that you can look at. Just take a look at that, and because it's just a good way so that you don't have to lose real money while you're getting started and refining and getting better at your trading practices. So that's the big rule. Only invest what you can afford to lose, because in reality, if you're just getting started, not really sure, exactly what you're doing, it's really easy to lose money in the markets very quickly. So have a plan, only invest what you can afford to lose. Number two, always have a defined win-loss ratio. So you can see here in the profit worksheet, these assumptions here. Let's say that for every trade, you're going to target a 10% return, right? And then you're going to set your stop loss at 5%. Okay? That means that if I invest, say, $1,000, or in this example, we're going to say every trade you place, if you have a $25,000 account, you're going to place a trade of $250. So in that case, a 10% return, I'm gonna sell my stock. I'm gonna set a sell order if I get a 10% profit, and then on the downside, I'm gonna have a defined stop loss or a trailing stop to sell a stock if it's down 5%. Always have a defined win-loss ratio. That's very important. In this example, I'm going to use a 2, right? So uh, for every 25 that I gain, uh, I'm only going to risk 12.50 on the downside in this example, right? Or anything. If I make $100, I'm going to lose 50. That's 2-to-1 risk to reward strategy. So always define your win-loss ratio and know your risk to reward. Stick with it. So the risk to reward ratio is, again, 2. So for every 10%, right, 5% loss, that's a 2-to-1 ratio. So always have that defined. Know what that is, stick to it. The third thing is to always have a position size, right? So have the position size and stick with it. So in this example, for a $25,000 portfolio, you're going to use a 1% position size. So every trade you place would be $250 on a $25,000 account. And I never recommend risking more than 1 or 2% of your portfolio in any one position. Okay, so again, because you're going to have losers there, so always minimize your downside risk. So again, we go through this example, have that position size, stay disciplined with it so that any one loss on a trade doesn't blow up your entire account, right? So the win-loss ratio in this example, I'm going to assume you win 40% of your trades, you lose 60%. So for the trade count in this example, that means you'd have, in this example, say 3,360 winning trades, 5,040 losing trades. And again, the trade size would be $250, 1% of a $25,000 portfolio. In this example, if you're a day trader, you're buying and selling stocks during the intraday, during the trading day. So your average days in trade, it might be 1, it might be 2, whatever. If you're a swing trader, maybe that looks 3, 5 days, maybe it's longer, a week or two. Just plug that number in there and always know kind of what your average days in your trade is. So in this example, the number of positions you would have, right, if you have a 1% position size, you're going to have 100 positions at any given time, right? Because 100 times 1 is 100 times 1% is 100%. So that's your total portfolio. Now the number of trading days would be 252. So there's about, with weekends, holidays taken out of the mix, there's about 252 trading days per year where the stock market is open. Your portfolio turnover rate, that's the number of times that your portfolio is turning over. So in this example, it'd be 84. So your total number of trades would be 8,400 in this example. So in a future video, I'll kind of walk you through exactly how to structure and formulate these metrics. Okay, so in this example, okay, if you have a $25,000 account, your win percentage is, say you win 40% of your trades. So for every 10 trades you make, you win 4, you lose 6. If you have a defined stop loss on your losing trades and a defined profit exit on your winning trades, then in this example, hypothetically, a trader could make something like, anywhere from $1,500 to $1,750 per month on a $25,000 account. Now, again, as you get more successful, or trading, you're going to have up months, you're going to have down months. But for the trader just getting started, this kind of lays out a groundwork for, what is a realistic, profit target or income amount for a given portfolio size. So we go back over to the rules here. The biggest thing here with successful trading is to automate. Always automate your positions, right? Automate your trades. So one of the biggest reasons that traders fail is the emotional aspect of it, right? It's when a stock goes up, a lot of times you get in that euphoria and you don't know when to sell, and greed is a natural emotion. It can kick in, and then you don't know exactly when to get out, or a lot of times you hold on to something, think it's going to go up and up and up, and then you don't sell in time, and a lot of times you can end up losing on the trade that you were winning at one point. So it's always important to set that, automate it through whatever trading platform that you use. I use Charles Schwab's Street Smart Edge. In that, you can place a trade, and then you can automate the profit exit and the stop loss, so that you place that trade, and then you can leave your computer, and then if the stock goes up, say 10%, it's automatically going to execute a sell order. Or if the trade goes against you, it goes down, you can set a stop loss at say 5%, and then that trade is going to execute if the stock goes down 5% after you bought it, right? So always automate to remove that emotional aspect of trading, which is probably one of the biggest reasons that traders starting out fail, right? The 95% of traders that fail. Take out that emotional aspect. So always automate your trading. Another thing you can do is called trailing stop losses and profit exits. I'm going to go more into that in a later video. I won't kind of dive into that in this video, but look up what that means. A trailing stop loss and a trailing stop loss is what that is. So take a look at that. Some other things to know if you're getting into trading. Know what the RSI is. That's really important. Relative Strength Index. Know volume. Get familiar with stock trading volume. Always know your technicals. Study technical analysis. I will go into that in future videos, kind of dive into each technical aspect of trading a stock. Things like moving averages, the 52-week high, 52-week low, day high, day low, the average true range, what's a stock doing on any given day, patterns, right? So a lot of patterns that you find, say a cup and handle or a wedge, or there's many other patterns that you can recognize when you get good at trading and you have some experience in it, where the probabilities would say after a pattern develops that the stock is going to go up or down. So always kind of research, know those patterns, look for gaps up or gap down. What exactly does that mean? Gapping up is if the stock, the market maker sets the stock higher on a given day, or sets it lower depending on the news of the day, or pre-market orders, buy orders, sell orders, what have you. Candle sticking, you can look into that. I'll go into that more in a future video. Bollinger Bands, I've kind of gone into that in a couple of videos. If you look at my video on the technical analysis of the SPY, you can see what those Bollinger Bands are. Take a look into that. And then what's driving the stock, right? Is there a news event? Did they come out with an earnings beat? Is there an activist investor involved? Depending on the did they win a new contract? Whatever the case may be, take a look at what's driving the volume and the trading activity in the stock, and that'll give you a good insight into exactly what is driving the stock price up or down. Now, again, this just gives you a good framework for starting to think about if you're considering trading either part-time or full-time. This will give you kind of a good outline framework on what to look for and how to structure your trading strategy so that you're better prepared for success, right? The biggest things are having that win-loss ratio, knowing you're not always going to know exactly, but if you set a predetermined, say you're going to aim to win 30 to 40% of your trades, and then having a defined profit and loss exit, and then proper position sizing. So again, recommend no more than 1%, maybe 2, but I wouldn't do any more than that. And then, that'll kind of give you a good idea or a general sense of what could your, estimated monthly income be. Now, again, you're going to have up months where you might do better, right, than this. You're going to have down months where you might do worse. But overall, if you limit your risk, you automate your trading strategy, and again, you trade based on what you know, what you're good at, getting those strategies and refining them, perfecting them, so that you know when to enter trades, or set yourself up in a position where you're going to be more likely for success when entering a stock based on technicals or fundamentals or patterns, anything like that. So hope this helps you guys, and thank you for all the viewers here, and we look forward to seeing you on a future video.